Materiality is misstatements that could influence the economic decision of users. It is auditor preliminary estimates of smallest amount of misstatement. This criteria used by accountants and auditor in distinguishing between important and unimportant matters. Auditor responsible to ensure the financial statement is free from misstatement. When the misstatement exists, audit should bring the matter to client attention to take action and rectify to give true and fair view.
The financial statement may contain of material misstatement and not so large until change the decision. Auditor use sampling technique in audit job to perform and complete on reasonable costs. For example, source of material is error and fraud, failure to comply with requirement of Schedule 9. The determination of materiality depends on company size and industry. It can be proved by quantity and qualitative factor. Audit risk can be measured using quantitative. For example, turnover 1%, profit before tax 5 to 10%, total asset 1%, equity 1%. Qualitative is amount involving fraud considered more important than error. Fraud reflect the honesty and reliability of the personnel involvement. Small amount misstatement could be material of bad consequences arising from contractual obligations. Misstatement possibly material if it affects a trend in earning. Immaterial misstatement still need to disclose to comply disclose requirement. Auditor minimize the risk of giving the wrong opinions by adopting a risk approach. Auditor accepts some level of uncertainty in performing audit function. They can reduce the uncertainty to a tolerable level through adequate planning, supervision and conduct of audit. Preliminary judgment. This is important matter since it can affect the monetary damage and bad reputation of auditor. They should plan to reduce the risk to an acceptable low level. The causes of uncertainty is I. Nature of audit test. 2. Inherent limitation. 3. Audit evidence that is mostly persuasive rather than conclusion. Type of risk is 1. Inherent risk. Risk exists with an organization, experience and professional judgment. 2. Control risk _ client internal control system. 3. Detection risk _ remaining material misstatements will not be detected by auditor. Inherent risk can be considered at two level. I. At the financial statement level or entity level consist of nature of client business, size, and number of location of the company, the management and other. 2. At the account balance and transaction level consist of result of previous audit, related parties, non-routine transaction and other.
Quantitative level and basis that can be used for valuing materiality. The quantitative base for materiality is a percentage which is technically 3% to 5% of 1. Total asset, 2. Total revenue, 3. Income before tax, 4. Gross profit, 5. 3 years average of income before taxes.
Factor that influencing determination of materiality. There are 3 factors that influence to determine the materiality. 1. Materiality is a relative rather than an absolute concept. When auditor check an item is material or not material, he need to use his professional judgment to decide. Example, RM 10,000 is material for the small company, but for the larger company that amount is immaterial. 2. Bases are needed for evaluating materiality. It is necessarily to have bases that to determine the materiality and also for the establishing whether misstatements are material or not for the company. Example, profit-oriented company. The net income before tax is the primary basis to determine what material for the company. 3. Qualitative factors also affect the materiality. There are 3 factors that give impact. 1. Changing trend. Changing trend, where the amount that is considered material may be material if they affect the trend in earning of the company. Example, if the report of income increase for the 5 years had increased for 3% annually but suddenly dropped 1% for the current year, such change to be considered material as it give effect the company earning. 2. Loan governance. Misstatement is considered to be materially if their possible consequences arise from the contractual obligation. Example, when the amount agreed as per the loan agreement is less than required minimum, therefore materially affect the liability of the company. 3. Conceals and illegal acts. There are involving fraud. Other consider more important material rather than unintentional error, even though the value and raiment for the misstatement is the same. The fraudulent act at the company may result auditor to increase their materiality level. Framework that affect user expectation regarding the measurement or disclose. Application of AuditRisk model to audit work. AuditRisk model. Audit risk. Equal. Inherent risk. Times. Control risk. Times. Detection risk. This model has been used by the auditor to manage the overall risk of an audit engagement. This model is useful when planning risk levels such as high and low. Auditor need to analyze inherent and control risk that related to an audit engagement while understanding the entity and environment. The residual risk formed by the detection risk after consideration inherent and control risk that related to audit engagement. If inherent risk and control risk is high, the detection risk will be at lower level in order to keep the audit risk at acceptable level. But when auditor believe that inherent and control risk is low, the detection risk is allowed to be set in higher level. Consideration of analytical review procedures. Definition. The analysis of significant ratios and trends, including the resulting investigation of fluctuations and relationships that are inconsistent with other relevant information or deviate from predicted amounts. Reason. To assist auditor in planning the nature, timing and extent audit procedure. As substantive procedures when their use can be more effective or more efficient than tests of the detail in reducing detection risk. As an overall view of the financial statements in the final review stage or enhance the understanding of the entity's business.
Audit sampling. Definition. Sampling involves the application of audit procedures to less than 100% of items within an account balance or class of transactions such that all sampling units have an equal chance of selection. Audit sampling can use either a statistical or a non-statistical approach. Sampling risk. Definition. The auditor's conclusion based on the sample may be different from conclusion that would be reached if a 100% examination were carried out. Auditor can lower the sampling risk by increasing the sampling size. 2 types of sampling risk. 1. In the compliance test or test on control. Risk of assessing control risk too high means that the risk that the auditor will conclude that the risk is higher than it actually is. Risk of assessing control risk too low means that the risk that the auditor will conclude that the risk lower than it actually is. 2. In the substantive test. Risk that the auditor will conclude that there is a material error when, in fact, it does not exist. And risk that the auditor will conclude that a material error does not exist, in fact it does exist. Types of audit sampling. 1. Statistical sampling, probabilistic sampling. Statistical sampling means any approach to sampling that has the following characteristics. A. Random selection of a sample. B. Use of probability theory to evaluate sample result. c. Defend measure at the court as it is systematic approach of selecting sample. D. Rely on a smaller sample for an intensive checking and make representative to a large population. 2. Non-statistical sampling, also known as non-probabilistic or judgmental sampling. The auditor must rely on his professional judgment rather than the laws of probability to reach a conclusion about the audit test. Auditor may use non-random selection methods and requires more subjectivity in making sampling decision. Lastly, auditor will select those samples item that he believes able to provide useful information. Categories of statistical sampling. 1. Attribute sampling. First used to estimate the proportion of a population that possesses a specified characteristics. Next, the most common use is for test of control, such as auditor wants to determine the deviation rate for control implemented in accounting system or internal control structure. And the last one. This measurement of deviation rate determines whether the internal control can be relied upon to process accounting transaction properly and support auditors' assessed level of control risk. 2. Monetary unit sampling. It uses attribute sampling theory and techniques to estimate the amount of misstatement for a class of transaction or an account balance. Designed primarily to test for overstatement errors and most appropriate for low error rate population of the sample results. It expresses a conclusion in monetary amounts rather than as a rate of occurrence.
3. Is classical variable sampling. It uses normal distribution theory to evaluate the characteristics of a population based on sample data of which data should have equal chance of selection. Determine the range of the data and selecting sample based on random table or computer audit software currently practiced by most big accounting firms for their big clients. The purpose is to estimate the amount for a class of transaction or account balance. Advantages of statistical sampling. Design as efficient sample. Measure the efficiency of evidence obtained. Permit the auditor to rely on a smaller sample. Plan the audit approach in systematic and specific manner. Non-statistical sampling. Part of the reasons is due to the auditor needs to consider the relationship between the cost of obtaining audit evidence and the usefulness of the information obtained. Often less costly and less time-consuming, but can be just as effective in satisfying audit objectives.
The similarities between statistical and non-statistical sampling are 1. Performing the audit and 2. Design of the sample. 3. Selecting the sample, and lastly 4. Evaluating the sample result. Differences between statistical and non-statistical sampling. 1. Statistical sampling. First, need to have knowledge on statistical formula. Next, objective results. Last, defensible in the court of law. 2. Non-statistical sampling. First is based on experience and common sense. Second is subjective result. And the last one is not defensible in the court of law. Audit sampling among firms. 1. Vary between each audit firm practices. 2. Common approach is random sampling. 3. Other type of testing, such as A. High value item and B. Other item.